Liquidity is all you need in trading, and it can literally provide guidance on every aspect of trading. In this video, I'll go over 8 ways it helps with examples. The final tip could be why you're losing trades. Let's begin. Now, starting with the first thing, that liquidity indicates price direction, or in other words, the draw on liquidity. So simply by understanding and mastering the liquidity concepts, you will know where price is heading to every single time, because liquidity acts as magnet in the price action, and it also acts as fuel or gas stations, because liquidity is the fuel of the market. Price needs to go to those liquidity levels in order to grab some fuel and then hit to the other direction, which is another liquidity level. We need to understand that liquidity can be external liquidity or internal liquidity. External are highs and lows, and internal liquidity is fair value gaps. If you have no idea about those terms, then make sure to watch my other video, especially my PD arrays video. Now, if you go and open any chart you have, and I'm using the weekly for now because I don't need to look at the details much. I want to see the big picture. You see, if we started from any point in this chart, so let's say at this point, I'm starting at this point and I want to know where price is heading to. What I'm going to do is look at liquidity levels that we have here. So we can say, first of all, is this liquidity level, and that's where price reached. Another liquidity level is this one, this pullback here. That's one. And another one is this one. So I'm kind of sure, because we reacted of this internal liquidity, we're most likely going to external now or another internal. What happened here is price going up, taking this liquidity level. Now, after taking this liquidity level, where are we heading to? Do we have any other liquidity level to the lower side? Yes, we have this one. Now, another time price goes and take the liquidity level that was just created here, because price was now ready to go lower. Now you see we're heading from this liquidity level to this liquidity level, and from this liquidity level to the other liquidity levels above, which is this one as well as this one. And I'm only focusing now on the external liquidity. When we look at internal liquidity, you see how we have this fair value gap, which after taking this external, we're coming back to the internal here. And what happened after testing that internal? We're hitting to the external. And what happened after from the external? We're actually coming back to the internal, which is those fair value gaps here. And then what happened after is we're hitting from this internal to the external here, and also to the higher the range here that we just took now. So what do you expect now in the British pound and the US dollar? Is we are coming back most likely to this fair value gap, which is the internal liquidity, maybe somewhere in here to equilibrium or 50%. And then we might push higher to the external again if we have enough confirmation. Otherwise, we might take this low or another lows in this curve here. So that means liquidity is magnet for price action. Any relative high or low that is relative to the range that we're having now can act as a magnet to the price action, and we can actually target that or wait for price to goes to that, look for confirmation and then enter of it, look for confirmation inside fair value gaps targeting the external highs, or look for confirmation at the external highs and look for retracement to the internal liquidity, which is fair value gaps. What can you also get from liquidity? Liquidity is actually the first step for A+ trades and A+ setup. So if you are focused more on trading high probability setups other than just trading any setup that you have, then liquidity needs to be the first step that you implement and you apply in that setup to make it A+. And I follow that rule that I have no raid or no liquidity sweep, then I have no trade. That's the first rule that I have, because either it is internal liquidity or external, but I need to have liquidity in that setup in order to make it high probability. And why is that? Because if I don't have liquidity sweep, then I might enter and then get that liquidity sweep, which hit my stop loss, because it can be a trap for me. So the rule is no liquidity sweep. That means I have no trade valid. So any setup and any strategy you trade, either support resistance, either supply and demand, you need to always wait for a liquidity sweep that happen on your direction to confirm that this is for now is a strong low, for example. Or if it sweeps a high here, that's a strong high, most likely after it breaks structure. So I need to apply that. And even if we apply the simplest strategy ever, which I always, take an example of which is the engulfing candle. Remember that if there is no liquidity sweep, it's not valid. So you see how here we have a liquidity sweep, we get that engulfing candle. In this case, it is valid. Why? Because we have a liquidity sweep. So even if you use engulfing candles by themselves, then this is the way you need to align them with liquidity sweeps. Now, in other times, you will see that they don't actually work when we have no clear liquidity sweep. So for example, here, you see how we have this high and we don't take the high here and we create an engulfing candle, then that one is not going to work. And why? Because we don't take the main and the major liquidity level. Now, even if you trade fair value gaps also, there are internal liquidity, but you want to align them with another higher low being swept. So for example, if we have a fair value gap here going to the lower side, if we have no liquidity levels here, then most likely the liquidity is going to be that high and is going to take that high. On the other hand, if we have something like this, other than this, we have high created here, and then we start going lower, and we have some sort of liquidity here. When coming to that fair value gap, it can be valid. And why? Because we have those liquidity levels here taken. So we have liquidity taken. That means the PD array can be valid. And that's going to be, I'm going to go more on details on this one in the next slide. Liquidity can also show you which PD arrays will be respected. What does that mean? Let me show you. Now, when looking at any fair value gaps, any order blocks, especially order blocks in this case, because they're going to be, very close to the liquidity levels. But let's talk about fair value gaps for now. So when we have price going up like this and then coming lower, creating a fair value gap here. The first step we need to validate this fair value gap is looking at this high and looking at if we swept a previous high and a very major high, not just any high, a very major high that we can expect price to reverse from. If we had a sweep, then this makes this PD array much higher probability. If we have no liquidity sweep, for example, we had in the previous price action, we had something like this, and then we start going lower. You see how here we had no liquidity sweep and we had nothing major here. In this case, what we can expect is price to disrespect this fair value gap. Now, this is not the situation every time, but if you apply this and only focus on the fair value gaps that were created after a liquidity sweep, you'll have much higher probability. Now, how do we see this on the chart? This is the 4-hour gold chart. I mean, if you look at an example here, see this fair value gap created here. We look to the left and did we sweep? And I don't want to see any displacement, above a high. We can see that we actually swept those two highs, relative equal highs or failure swings. We swept here and immediately we create that fair value gap. So this is now is a valid fair value gap here because we swept. On the other hand, if you see here that we were going up, coming lower, and then going up, did we sweep, for those fair value gaps here? Did we sweep any major low before creating that fair value gap? Not really. There's nothing. That's why those fair value gaps were not respected. And it's also because of this liquidity sweep here. It makes this now less probability. Overall, there's no liquidity sweep here. That means this is a weak one. There is a major liquidity sweep here. That makes this fair value gap much higher probability. Now, there is nothing as 100%. You'll see sometime that we might not actually take any liquidity level. For example, here, maybe create a fair value gap, but still get respected. And sometime we will take liquidity levels, but don't get respected. But the main thing is we want to be on the side of the higher probabilities, even though sometimes whatever we're following is not going to work, but we are on the higher probability side. We prefer to stay with the liquidity sweep, fair value gap, because it works more on the long term. Now, we talked about PD arrays and how to confirm them using liquidity, but how do we actually identify manipulation PD arrays also by liquidity? It can also do that. How? In order to confirm a high probability PD array that's going to work, we're going to look at liquidity sweep that happened before the creation of the PD array. On the other hand, to identify manipulation PD arrays, we look at liquidity sweep happening after the PD array. Let me show you an example. So let's say that we have price going up and then reaching this point, and we had a bullish fair value gap that is created here. Now, there is no liquidity sweep here, or if there is one, let's forget about it for now. if price sweeps a liquidity level here, that is after the creation of the PD array, most likely that's a manipulation fair value gap or manipulation PD array in general. Let me show you how. Because what we do is we looked at the other way in order to confirm a high probability one, but we look at the opposite way when we look for a manipulation fair value gap. You remember that what we say is that we need a liquidity sweep in order to confirm this as a valid fair value gap, something like this, because we had a liquidity sweep prior to the creation of the fair value gap. We're going to look at this in the other way. Let me zoom in. Before this liquidity sweep, did we have a PD array? Yes. This is a bullish fair value gap. And then after that, we had a liquidity sweep. This liquidity sweep here invalidate this fair value gap, makes this a manipulation fair value gap. What does that mean? Price might come here, maybe give a small reaction on the lower time frame, but it's going to be disrespected. All of the liquidity here is going to be transformed here to go lower. This fair value gap is only being created in order to push price lower and not higher. It's totally the opposite. Let me show you another example. This fair value gap here, you see how we're going lower and we created this fair value gap. Now you ask yourself this question: after creating this fair value gap, did we sweep liquidity level? We sweep this liquidity level and we're coming into this fair value gap here. So that means this most likely will be a manipulation fair value gap. And you see how we give some reactions from here, some reactions from here, and also maybe some here, and then we disrespected it. What happened after is we came to it because it's inverse now. It acts the other side. It's pushing price higher. All of the liquidity here is used to push price higher. A lot of traders are trapped here with their stop losses, maybe above the fair value gap or maybe somewhere in here above a high. But all traders going short are trapped here because this is a manipulation fair value gap. And how can you identify one? By using liquidity. So you see how it acts the other way here, pushing price higher. Now, one final example, let me show you very quick. See how here we sweep this liquidity level, creation of a fair value gap before, because we did not actually displace much below this and it's a liquidity sweep. That means this is a manipulation fair value gap. And you see how we get some reaction of it, but then eventually we closed above it. We come back to it. You see the retest here, and we just start pushing higher from there. And you can see this everywhere. And a lot of people not understanding liquidity and not taking advantage of some of the videos that I posted. They don't use this and they fall into this trap. Tip number 5, liquidity can actually help in risk management. And when I'm talking about risk management, I mean mostly stop losses, but it can also help with taking profits and when to go break even. Let me show you how. So if you have price going up like this, and I'm going to demonstrate this and maybe talk about it more in the market structure slide. So you see, if we have price going up like this, an entry somewhere in here, and then price is going up. Now at this point, you're not going to break even. Maybe your stop loss is below this low. After that, if you want to trail your stop loss, you see how we're going lower and then going up here. And then what happened here is sweeping liquidity and then breaking structure. After sweeping liquidity, most of the time, the low that swept liquidity is becoming a strong low. So you can actually take your position if you entered from here and then stop loss below the low. You can transform your stop loss from this point to this point here. That's going to be your stop loss because you're trailing your stop loss to levels that if it gets broken, then most likely it's not valid no more. And now when it comes to take profit, you also need to be aware you're not targeting those levels where we have a sweep. So let's say we have, we're going long and we have some levels like this on the upside. We have something like this, and then we have those levels, and we are entering maybe here, right? Going higher. Instead of targeting this one, which is a strong high, which price will kind of struggle to come here, we're targeting maybe this high or this high instead of the strong high. That price will not go there easily. But mostly I want you to focus on the stop loss placement. Stop loss needs to go below strong lows and above strong highs, because that's where if price goes there and break below, maybe that's the invalidation and not just any high or low. Liquidity can signal trend completion. So you can predict when the trend is about to end using liquidity. And you can also confirm if we're still continuing up also using liquidity. Now, one of the most important rules when it comes to trading liquidity and trading in general, and that can actually change the way you look at trading. When we have a closure above or below a previous candle, that means we have a continuation. The moment we have a wick and now closure below or above a previous candle, high or low, that means we are about to reverse. There is a higher probability that we are reversing. What does that mean? Let's assume that this is a bearish candle, this is the wick, and this is the closure, opening price here or the next candle. We go lower and you see we fail to close below and we only sweep the liquidity. Most likely we are about to go up in this case. However, if we actually close below and we have something like this, closure below, and this is the wick here, then most likely we are about to continue lower. That's one of the most important rules in trading. Now, if we go and look at this 4-hour chart, you can see the moment we reach a liquidity level and we fail to close above, then most likely we are about to reverse. You see here, fail to close above, we already push lower. Now, anytime we fail to close below, that means the trend is about to end. And you can see here, this bearish trend, the moment we're not able to close below this and we wicked below, that means the trend is about to end. Now we go up and we have no closure above this level. And you see how we actually started going lower. Now the trend was not that big, but you see at this point here, actually we failed to close below. That means we're about to go up. And here we sweep this only with a wick and we failed to close below. What does that mean? That means we're about to go up. And you always look at the fail to close above or below as a signal for reversals, as well as same thing. You see here those candles, and all those candles we actually were closing above the previous candle high, until we have this one, this candle here. We failed to close above and only wick. That means it's getting weaker and weaker. However, when we have something like this where we have this candle high, we closed above, and here was not ready to go up, but then we closed above again, we closed above again, we closed above. The moment we fail to close above, we get some weakness. So weakness means either we are consolidating in order to push higher, or if it was in a major liquidity level, failing to close above means we're about to have a reversal. That's how we use liquidity to confirm if we are still in the trend or the trend is about to end, and we might either have a consolidation or we might have a reversal. Then liquidity can help identify valid market structure. A lot of people think that in a market structure is just looked at higher highs and higher lows, or the opposite. That's it. That's the market structure. When we break structure, it means we have a low and etc. It's not the right way to identify market structure. It's not valid. Let me show you the valid way of marking the structure. As I said, a lot of people look at market structure this way. We are breaking a high, then we are in an uptrend, and those are the highs where we looked at price to hold, right? And we don't want to see any time price is going below this level. However, if we think about this from a liquidity perspective, how we look at this is that this one, this low here, it's not actually a strong low and it's not part of the structure. Maybe sometime it is, but most of the time it's not the highest low here. It's not the strongest low unless we take this liquidity and then push higher. In this case, this now becomes the strong low. That's how we look at strong lows and strong highs. Now, how do we deal with strong highs is something like this. So let's say we actually switch the structure, something like this. We are pushing lower, right? This might not be the strongest high. In order to confirm a strong high, we might want to see liquidity sweep and then a breakout structure. In this case, this liquidity sweep and this breakout structure in the sequence, sweep and breakout structure, that confirms that this now is a strong high. That's the right way to mark your structure, not just this high that took the low. This is actually one of the ways that a lot of ICT and smart money concept traders fail into this trap, because they just think that this is pattern, right? We take this low, that means we have this as strong high. Maybe in this case, yeah, because with liquidity, but not in this case, because we just come to maybe a fair value gap here, we push lower, but there is a major fair value gap above. That's going to be the liquidity sweep into that major fair value gap, and then we push lower. That's the real breakout structure. That's the first thing. And that's the real strong high here. That's how we look at market structure. Number 8. And that's one of the mistakes that I was actually making. And I just realized after some time that there are some trades that I take and price flies to the take profit, while other times I enter and I see nothing but consolidation, and then I'm hoping that it goes to my take profit and eventually it goes to my stop loss. And what is the reason? Because I was actually trading in a high resistance condition. But what liquidity can actually help you with is reveals the low resistance conditions. What does low resistance conditions mean? It means that you're trading in a condition or in an environment that price can go to your take profit much easier than trading in high resistance conditions. Let me show you some examples. So this is gold on the 4-hour time frame. Let's start first with the high resistance condition, which are the conditions you don't want to be in. You see, in this case, let's say that you are looking for the sweep and then you're looking for price to push kind of lower, right? To take all those lows. Does it make sense for price? I mean, think about it for now. Does it make sense for price to go now and take all those lows? Let's say you enter from here. That's your stop loss, maybe above here, and you're targeting this low. Is this a high resistance conditions or low resistance conditions? What do you think? That's indeed a high resistance conditions. And why? First of all, one type of high resistance condition is strong highs and strong lows. And what does that mean in other words? Liquidity sweep. You see how we had a liquidity sweep here and then we break the structure? That means this is now a strong low. I cannot target this one. And another type is also those fair value gaps here. You see how we have about two or one fair value gap here. This one, after the liquidity sweep, it pushes price higher. So you're entering short here and you're ignoring all those high resistance. There is a lot of resistance here in order to push price higher. Price will not easily go lower. There's a lot of resistance here and there are a lot of confluences that will not let price go lower. So that's a fair value gap and that's a strong low here. You see, price push higher and you get, after some consolidation, you get your stop loss hit. Same thing here. So let's say you enter long from this fair value gap as an example, this fair value gap, and you are entering here, stop loss goes below the low, and you're targeting maybe this high or maybe 2 to 1. Okay, so let's say 2 to 1 here. Does price get to your 2 to 1? No. And why? Because in this case, we have high resistance liquidity. We have price sweeping a high and then breaking structure, and we have fair value gap here with a liquidity level. Price eventually respect this one because you're trading in a high resistance condition. I mean, sometimes price could actually go up and break all those resistance, but it's not going to be easy. It might take a lot of time. You need to be on the lower resistance side. Now, same thing here. You see, high resistance. First of all, the liquidity sweep and then the breakout structure. And what you can see here is that we have one fair value gap, 2, 3, and 4, all those fair value gaps here. This gives a lot of resistance here. And you see, price was actually consolidating here until it goes lower and maybe hit your stop loss. Eventually it goes up, but you see how much time it takes to break this resistance here? Actually a lot of time. And you see, you don't want to be sitting here, maybe going lower again, and you'll either hit your stop loss or hit your break even. Now, what are some low resistance liquidity conditions? You see here, we have high and a lower high. We have a failure swing, and we don't have a lot of fair value gaps here. You see, this fair value gap is already filled, and we don't have much fair value gaps here to hold price from going higher. And what happened? Let's say you enter, I don't know, somewhere from this order block or for any reason. Okay, that's not the topics of today. You see how immediately price goes to that take profit, like in no time, like immediately, unlike the other ones where we consolidate for, I don't know, a month. Now, same thing here. This is a low resistance condition. Why? Because we have a high and a lower high. And we have a fair value gap here, yes. But then there's also another low resistance liquidity condition here, which is high, another lower high, another lower high. Those are the best to target. Price immediately goes up to take those levels. And then maybe some resistance from this fair value gap here. But we have some low resistance here. That's why price just gave some reaction from this resistance here, and it immediately takes those failure swing and then it goes lower. That's why we need to be on this side of the market and not the high resistance. We should always be with the low resistance conditions. Thank you for watching the whole video. I hope that I did not waste anyone's time. If you wanted to help other people to get this video, then make sure to share it with other friends, subscribe to the channel, and leave a like and a comment. That's all I'm asking for. Thank you again, and I'll see you in another video.